This is FRM Part 2, Book 3, Operational Risk and Resiliency, and the chapter on High-Level Summary of Basel III Reforms. This chapter was written by one of the Basel committees and is indeed a summary of the reforms. And if you read the introductory paragraphs, one thing that should catch your eye is this emphasis on strengthening. And I like that part of this chapter because the sense is that we know that the Basel committees have been around since the late 1980s and that it is a dynamic committee that follows a dynamic economic and financial process. And so these reforms are, of course, the result of the 2008 financial crisis. But in implementing these reforms over the course of time, the committee has learned more and more. And so these reforms are probably more precise and more effective. It's worth noting that this was published in 2017, so a full, 6 years or 7 years after the crisis ended. And so there is a sense of learning curves and learning opportunity that you get throughout reading this chapter. Learning objectives, there are only 3. And some of this material we have covered before. Look at that first one. Explain the motivations for revising the Basel III framework. Well, we already know the answer to this question in a general sense. We know that we had some weaker regulations and ineffective processes, going back to, say, 2005 or so. But now the impact of this Basel III framework can be seen through December of 2017. We'll go ahead and summarize those revisions. I have a slide for each one of those areas, and then we'll spend a slide or two at the end of the slide deck on the revised output floor, which is a fairly interesting concept, and we'll talk about a little bit about why it might have been controversial and how it's going to work. So before we get into that first learning objective, let's go ahead and look at a brief recap of some requirements. And I love this part of the chapter because read that first circle point there. Basel II did help avoid a total collapse. However, weaknesses ultimately contributed to the massive losses for banks. And so I like this because, throughout the world, nobody is going to punish you for making a mistake. In fact, lots of people are willing to forgive as long as you learn from that mistake. And I get that sense in these series of chapters that there were some weaknesses and that there's room for improvement. This is really all we ask each other as humans. Learn from your mistakes. How about that second block point? The Basel III was agreed upon by all those nations in 2010 in an attempt to find solutions to the weaknesses. And so this is, once again, looking backwards, trying to figure out what worked, what didn't work, and how we can move on, to prevent, a collapse or a financial crisis or a taxpayer bailout. There are some controversies here, and some of these are relatively impactful. And so the committee decided not to throw this all at the financial institutions in 2017 and say, okay, here are the new set of rules. Have a nice day. And so probably what's going to happen is that these are going to be rolled out over time, possible implementation starting in 2022, which of course is not too far away from where we are now. All right, let's look at that very first learning objective, motivations for revising the Basel III framework. All right, improve robustness. So what is that? Let me just remind you, what does that robustness mean, especially as it applies to specific models or approaches in risk management? That word robust means, strong and healthy. And of course, the implication is that you're strong and healthy not only during strong and healthy times, but during weak and periods of stress. So the robust approach has to be equally applied to periods of low volatility and periods of high volatility. And this is for, what did I mention? I mentioned risk management. So here the chapter emphasizes credit risk, credit valuation, operation risk, and then those CVAs that we talked about in one of those previous chapters. I have a whole slide on that, and I'll go ahead and we'll talk about that a little bit in more detail. Here's the next one. I like this one, to restrict the use of internal valuation models. And so think about this. If I'm Jim and I'm a financial institution, even if I'm Jim's Rock of Gibraltar and I'm this gigantic bank holding company, I'm going to think that I'm really smart and that I can come up with my own internal model to evaluate all of these risk management principles and risk measures. And maybe I suffer a little bit from hubris. Maybe I suffer from a little bit of overconfidence. Maybe I just think I'm smarter than everybody else, and it doesn't have anything to do with my position in the financial industry. And so what happens if we have these internal evaluation models, if I have mine and you guys have yours over there and they have theirs over there, that this internal ratings-based approach is probably not going to be consistent, and it might not be effective. And it makes for tough times for regulators to wrap their arms around problems as they arise. We've talked at length about these systematically important banks. This revision seeks to limit that leverage by introducing a leverage buffer. Now, we've talked about the need for a buffer. So we have this little storage unit over here on the right-hand side of the balance sheet that we can look to and say, all right, if something bad happens, then I have this buffer. And so what this revision of the Basel III attempts to do is to limit the ability of these gigantic financial institutions from becoming over-leveraged without having that buffer. I mean, of course, the nature of financial institutions is that there's going to be leverage. And then finally, and this is the one that is a little bit more controversial than the others, that we're going to replace the existing Basel II output floor with a more robust risk-sensitive floor that's built on some standardized approaches. And let me just, kind of give you a heads up here. This output floor is probably designed to reduce the lack of consistency inside of these risk-weighted assets that probably don't capture all of the underlying risk levels. And so this standardization approach or the standardization technique is going to put some more granularity into this output floor. Here are the main elements of reform. So there's the standard approach right up at the top left. Here we go. Improve granularity, risk sensitivity. And notice what we put in boldness there. Reduce the reliance on credit ratings. And this is one of those areas where we're trying to learn from our mistakes, right? So we've got all these independent ratings agencies out there, and sometimes they make mistakes. And what we want is that we want to be able to rely on these credit ratings, but we also want to be able to verify them internally. So reducing the reliance on credit ratings means that we're going to increase our reliance on our ability internally to establish some kind of a rating outside of the firm for all of these other investments or other securities that show up on our balance sheet. So there's that second one. What we're going to do is we're going to drop this advanced IRB approach on low default portfolios and equities. And this is kind of consistent with what I said just previous. Now there's the aggregate output floor. Now when this concept of an output floor was introduced, I think this goes all the way back to, Basel I in 1992. I think that percentage was 80%. And it didn't include any sensitivity to risk weights. So now this main element of the reform, 72.5% of the total risk-weighted assets. And this is going to be used using these standardized approaches that we've talked about previously. Enhanced CVA risk framework. Let me go back to the example that I have given you guys multiple times over these recorded videos. All right, here's my financial calculator. You and I agree to trade this calculator in 6 months for $100, right? I'm the seller, you're the buyer. We signed some kind of derivative contract, maybe just a simple old forward contract. Now, as time goes by, let's suppose this calculator price increases, the spot price increases to, let's say, $300, right? So you're delighted as the maturity date approaches because all you have to do is pay me $100 and then you're going to go sell this calculator for $300. But boy, what am I thinking? I'm starting to think, okay, as this date approaches, do I really want to sell this to you for $100? Because I have all these people over here saying, hey, Jim, we'll pay you $300 for it. All right, so what are we going to do? This credit value adjustment. I mean, clearly, let's suppose we're marking to market, and on your financial statements, you have, what did I say, $100, price is $300, so you have $200 written down as, hey, I've got this $200, I can't wait to cash in. But I'm smart too, and I know that as this date approaches, and if that price stays at $300, I'm going to not be very happy about the terms of this transaction. In fact, what I might do is when you come knocking on my door and say, hey, Jim, let's complete this derivative contract. Today's the maturity date. I may run out my backyard and hide from you. And then what are your choices? You can chase after me, but I'm really fast. I used to be an athlete, and so I'm fast, and I'm pretty sure I can outrun you. So you can run, and you're out of breath. And so sooner or later you say, Jim is a nut. I'm not going to do this. I'm going to go get a judge. And so the judge comes in, you take me to court, and the judge says, all right, Jim, you're guilty. And I say, wait a minute, I sold that calculator for $300. And then I took that $300 and I went and spent it somewhere else. And I said, but wait, here, I got this. I know my wife has a calculator because she doesn't like this calculator. She always says to me, how could you have bought a calculator that doesn't have an equal sign on it? And I said, come on, dear, reverse notation is not that hard. So I have this calculator, and I'll say to the judge, here, you can have this calculator instead. So you have to accept that calculator. Maybe you can sell it for $20 or $50, whatever it is. So you need to make these credit value adjustments to reflect the simple fact that I'm faster than you are, and I may substitute some underlying asset to fulfill those terms of the contract. And so look at what we've written over there. Make it more risk sensitive and robust by removing the use of the internal model approach. So you might have this contract with me, and then you might have all these contracts out there for financial calculators. And so what we don't want is that we don't want to put some kind of a uniform attachment of this CVA to all of your contracts. We want to make sure that you look at me and you say, boy, Jim is fast. There's no way I'm going to catch him. So I need to make sure that I don't have 200 written down on my financial statements. Maybe I have 50 written down on my financial statements. That was a fun story for me to tell. I hope it was a good analogy for you. All right, how about operational risk? All right, so we're replacing all the existing approaches. And remember, we talked about this in previous slides, that there are a bunch of different ways to do this. So we have our single risk-sensitive standardized approach. So that's important. Risk-sensitive, I mean, it's standardized, meaning that it's similar like this. It's similar, but in the depth of each one of these cases, we can assign some value for risk. And then there's this extra leverage ratio buffer for these large bank holding companies to prevent some contagion or some overlap or some seeping into the general economy, so that if one bank holding company fails, then that kind of draws other bank holding companies and other organizations and entire economies right down with it. All right, how about the learning objective concerning the revised standardized approach for credit risk? All right, a couple of things here, 3 things actually. Improved granularity and risk sensitivity. Boy, I mentioned that here over the last couple of slides. So here's the example that we've come up with. Instead of assigning a flat rate to all residential mortgages, now we're going to assign a risk weight that is linked to some other metric, like a loan to value ratio, which makes perfect sense, right? My loan to value ratio in my particular house right now that in which we live is way lower than my daughter's loan to value ratio, in which she and her husband just bought this house, a year and a half ago or so. So it makes perfect sense then that we're improving our risk sensitivity. And then as we get down into the more granularity of the financial statement in each one of these loans, then we're evaluating these loans on their own merit rather than just lumping them into a pool. Now, that second one we've talked about before here, reduced mechanistic reliance on credit ratings. Look at the second circle point. I like that one. If external ratings have to be used, then due diligence must be exercised. And I've emphasized this to you guys in previous recordings, that due diligence means get out and get your shovel out and put your gloves on and work hard. Figure it out. Go ahead and do your own evaluation of credit risk. And then, of course, whenever we're forced to take a haircut, like you were forced to take a haircut in our little calculator derivative contract, they are defined for that security that can be used as collateral. Like, for example, you might say, you know what, Jim, your wife's calculator is probably not going to do it for me. All right, how about internal ratings-based approaches? All right, so look at this here. Discontinued use of this advanced internal ratings-based approach because as an internal model, there are many ways that this can be inaccurate and ineffective and probably inefficient as well. These includes exposures to large and mid-sized corporates, banks, and other financial institutions. All right, now I like the second one there, greater specification of parameter estimation practices. All right, and so there are some guidelines here. We have two pretty simple examples, but there are guidelines of these parameter estimates. Now remember, when we make an estimate, we know we're going to make that estimate with some error. So we want to try to minimize that error term. And then minimum input floors specified in situations where the advanced IRB approach remains available, all right, to ensure that we put some kind of a conservative estimate on this approach and all of these metrics that come in and out of the model. All right, here's this slide on the CVA risk framework. All right, so what has to happen is there has to be an increase, there has to be an enhancement of risk sensitivity, right? So the CVA risk driver, this exposure component that we talked about between you and me, has to be taken account along with any hedges, because look, you may have this forward contract with me, but you might have another offsetting position with someone else, maybe for a lesser financial calculator, maybe for a different price for this financial calculator, or maybe some other terms. Maybe it's longer term, maybe it's shorter term. So we need to consider all of those extra hedges. More robustness. So what does that mean? We want to be stronger. We want to be more healthy. We want to make certain that any internal model that we use is going to stand up to the tests of low volatility periods and high volatility periods, which of course include stress periods. And then that last block point down there, of course, more consistency, meaning that this approach can be applied throughout the entire industry. Now, how about an operational risk framework? All right, so notice what's happening here. They've been replaced. Those three existing standardized approaches have been replaced with a single risk-sensitive standardized approach that all financial institutions must use. All right, so it's based on the bank's income and the bank's historical losses. So we've got this internal loss multiplier We have this business indicator component, and we've got some ratios in here, and it can be summarized by a loss component equal to 15 times a bank's average historical losses over the preceding 10 years. Now, of course, these large bank holding companies are going to have this buffer has been set at 50%. And there are also some restrictions on dividends. And so if these ratios, if this capital buffer is not met or is not met completely, then there are restrictions and constraints on dividends that the bank holding companies are allowed to pay. All right, this revised output floor, as I said earlier, places a limit on the regulatory capital benefits that a bank can use in internal models, right? So this aggregate output floor set at 72.5% of the total risk-weighted assets, and this has to be calculated using those standardized approaches. And by the way, there is a great table inside of this chapter. It runs 3 pages long. There's no way we could replicate that and put this in a slide deck, but it gives all these risk weights for lots and lots of different components of financial statements. And it's probably worth looking at in the longer sense. But what you'll note in there when you're looking at that table is that those risk-weighted assets must be calculated as the higher of either that 72.5% or the total risk-weighted assets calculated by the bank with supervisory approval. Now, when computing that floor, the banks have to consider credit risk and counterparty risk, credit valuation, adjustment risk, market risk, operational risk, all of those. And of course, we've got to use that standardized approach as well. And then there's some extra issues for securitizations. And I think that takes us through these learning objectives. So once again, I'm gonna go back to what I told you in that previous recording. Remember, our last couple of chapters were regulations before 2008, regulations after 2008. And this is kind of an essay on regulations after 2008, but these are really super important. So I'm guessing that there might be a question or two, before, and then a couple of good questions after, but this sounds an awful lot like these are the better questions because these are way more relevant to the current economic conditions and the current state of the financial industries.